for a bit of a change in our webinar timing. So I hope it suits everyone quite nicely. Thanks for everyone who's joined so far. Good to see some familiar faces in here. Bert, Wendy, Bradley. It's been a while, Bradley. Awesome to see you around. And Karen. Quite a few people here. So awesome to have you here. Hitesh, sweet. All righty. Well, let's not muck about and get into it. Hey, I guess the topic for today is all about estate planning and asset protection. In fact, that's kind of how we're going to approach it. Is talk about asset protection and why it's it's kind of been really important forever, but why it's important now, and it has been important over recent times, but also estate planning as well. Again, similar thought process on that. It's always been important, but it should always be part of our conversation when we're working with clients at Inspire, that we make sure that this sort of stuff is covered off on. Before we get into that webinar, though, I do want to bring up some other events we've got coming up. One of the next ones is, this is actually at the end of next week. We've got Paul Dunn. I haven't actually presented with Paul Dunn in probably a couple of years now, but he was a mentor to me early in business, and he's going to share some cool things all the way from Singapore, over Zoom, of course, but why your business needs a brand new story right now. We're going to cover the most important step to take and how easy it is, how taking that one simple step gets you into a real premium pricing position, and how it multiplies the value of your business by 4 times and sets you up for life. So the mysterious Paul Dunn will be joining me at the end of next week, and I will just keep an eye on. Yep, cool. Here we go. Rose has already beat me to it. She's posted that link in the chat box. Awesome. And Bradley, just saw your comment about hopefully your good friend Anna. She's not my good friend. Will let us enter Queensland in the coming decade. That would be very good, mate. But your guess is as good as mine to that one. Yeah, definitely factually incorrect on her being my friend. All righty. Another event we got coming up on the 11th of the 11th is Are You Doing the Best You've Ever Done? So weirdly enough, there's obviously some businesses that haven't done very well at all with lockdowns and crashing tourism and hospitality and all this sort of stuff. But we are seeing quite a big portion of our client base and even the market having their best year ever. So it's pretty cool to see. And what we're also seeing is that given the Australia's state borders are opening slowly and international borders shortly following that, what we're predicting we're going to see is a huge influx or a huge rush. And even with the lockdowns ending in the southern states, we're seeing this with the face-to-face sort of businesses where the queues out the door for the hairdresser and people who've put stuff off are all that built-up demands coming back. And even things like just small, I think even trades had to put their tools down for non-critical repairs and that sort of thing. So they run off their feet as well. So yeah, we're going to actually have a webinar focusing on what do we do, how do we handle this, even things like the Great Resignation, like how does that impact your business and getting good team members to join. So that is the focus of this webinar here. And then practical steps, like if you've had your best year, you're probably going to have a tax problem. So, it's not a bad thing. It's a good thing to have a tax problem because it means you made money as long as you're not paying any more than you need to. So cool. That is all about that one. And then the following week after that, I am joined by John Hollenberg. Again, a man I've presented with before. He runs a website design agency called 5x5 and is a good friend. He's done our websites, multiple, including the one that we're launching in a few weeks, which is very, very exciting. So he's going to present on how to create a kick-ass website that actually works. And I think by works, he means converts into inquiries for your business. And again, all these links are being posted by Rose in the chat box. So if you do want to register for any of these, please do that. Now, a bit about me. If you don't know who I am, my name is Ben Walker, and this is my family. I've got Stevie, is my wife there, And Rose, where Stevie's holding her, is about 18 months ago, but she's a lot bigger now. And Ezra there, who is just cracked 10 months old. So they're the special people in my life. And then from a professional perspective, I started Inspire when I was 23 years old. So that's about almost 9 years ago now, if anyone wants to calculate my age there. I'm an award-winning chartered accountant with 13 years accounting experience, and I co-authored a book in 2018 called Cashed Up, which outlines our 7 steps for pulling more money, time, and happiness out of your business. So that's a quick intro to me. In terms of Inspire as a business, we've helped our clients save over $17 million in tax and counting. We don't just do the tax part of it. That's usually where the conversations start, though. But as you'll discover, even in this webinar, we cover other topics around asset protection and estate planning very well with the people that we work with. So just a bit of insight to the business, and also this relates to Paul Dunn, who I mentioned earlier. He runs this global giving initiative called B1G1. And through B1G1, for every $1 of tax we've saved a client, we've given access to food, water, health, or sanitation, or a day's worth of access to food, water, health, and sanitation to a family in need. So that's clicked up to 17 million days of impact, which is pretty huge and pretty humbling, actually, over the last few years. Now, also, if you do have to take off early, but you do want to have a conversation further about something that we mentioned on the webinar, we do have an option for people who are listening to book in a strategy call with one of our accounting team. Our accountants are all trained on this stuff that we're talking about, asset protection, structuring, estate planning. So yeah, we can sort of bounce off any other questions that we don't get to answer on the call today, on the webinar, sorry. So you can book in a chat with them. And again, Rose is being an awesome help and has posted the link for that one in the chat box. Awesome. Now, what I want to do is, if you've got some questions around asset protection and or estate planning, can you please get them ready? And you can either post them to me in the chat box, like directly to me, and I think you do that by either selecting my name or panelists, and then I'll only see it. So I can keep those questions relatively anonymous. Otherwise, you can just pop it in to everyone if you're okay with me sort of workshopping it and maybe mentioning your name. So I'll be sort of careful about that, given some of this stuff's pretty private. But if you do have a question, get it ready. But obviously, I will be answering questions as we go. So we're going to cover asset protection first, and then we're going to shift gears into estate planning. And the whole context of there is, once you've built assets, let's make sure we protect them. And then, unfortunately, death is inevitable for all of us. So we want to make sure that we pass on the assets that we create and the wealth that we create over our lifetimes in the way that we actually want it to be passed on, and making sure we do that in a way where we're not going to, the next generation is not going to destroy it. Awesome. So why are we here to talk about asset protection? The first thing I'll start with is the 4 categories of risk to a business. And some of you might have seen this stuff before, but it's worth mentioning, like, why are we even having this conversation? Because sometimes it's hard to go, oh yeah, actually that's why it's important. And often with asset protection, you don't necessarily feel like you need it, or want it rather, until you actually need it. So it's one of those things that you may not appreciate it unless you have the genuine need to call on some of these strategies. All right. So the first category of risk to a business is their clients. Now, it kind of depends on the industry you're in to the amount of risk you take here. Also, like professional indemnity insurance and things like that does take a huge amount of risk off the table. But again, there's still instances where you may not be covered by insurance and you still want that protection. Another one is suppliers. So clients is people who pay you money. Suppliers are people who you pay money to. It can include your normal suppliers, the ATO. So anyone you pay money to. And where we kind of see common disputes there is more so with the big stuff. So whether it's a big supplier and you're arguing about pricing or payment terms, or you haven't paid rent for 6 months because it's COVID. All those sort of things is where you might get into a bit of hot water there. So that's that one. The next one is employees. And this is actually quite a significant risk to a business with, fair work. And unfortunately, it's hard being a business owner to be unbiased to this, but it seems like the legislation is actually written in favor of the employees. And yeah, we don't want to be silly about it, but we also don't want to be exposed unnecessarily or to serial pests who might just want to have a crack at a business owner just for the sake of it. So it is a bit of a minefield, all that HR law and employment law, but it is a significant risk to a business. And the last one there is competition. So, or competitors. I don't think this is a huge risk unless you're doing things like nicking someone else's IP or, grabbing their logo or things like that. You may, if you've got a competitor who doesn't appreciate that, they might fire a missile or two over. It is what it is. But yeah, just keeping that in mind as well. Now, so they're the things we need to be sort of concerned about or aware of. But how do we kind of help? How do we improve your asset protection or minimize the risk that those people impose to us? Well, in my opinion, risk to a business owner is actually on a continuum, like a sliding scale. And obviously the more money you spend in implementing strategies, the further along to the right-hand side you get, or the less risk you carry. And the goal is to kind of sit wherever your risk tolerance sits, not just spend money for the sake of it. So I'll kind of walk you through the different, I guess the high level of asset protection, where very high risk is running your business as a sole trader, and therefore you're exposing all your personal assets as well to the running of the business. You're not a separate legal entity to your business. So if it was, let's say it was me running Inspire, it would be Ben Walker trading as Inspire Accountants. So not a great idea. We never recommend that for business owners to run as sole traders, not only for the asset protection downsides, but also the tax downsides as well of not being able to approach tax planning wisely. So there's the old sole trader. Now at Inspire, we talk a lot about getting your structure right. And I've got PTY Ltd, which is code for company, and then also trusts over here. So companies and trusts take you a fair way along this spectrum or this continuum. And the reason why they do it is this line they create between the director of the business and the entity itself. And what we call that is the ASIC's corporate veil. That means that the company or the trust with a company trustee, I'll use kind of jargony words there, is actually seen as a separate legal entity to the director themselves. And that is one layer of protection between the person running the business and their own personal assets. So yeah, that does help us, but there's things that we need to keep in mind when we're running, when we're doing this, because that's not the be all and end all of asset protection. There's a few things that can get through good old ASIC's corporate veil. The first one is fraud. Now, my kind of comment on fraud piercing the corporate veil is fair enough. Sounds appropriate. Shouldn't be intentionally ripping people off. Not much more to say than that. The next one is director's guarantee. So if you sign a lease or buy a vehicle on finance, there's a few other instances, even supplier contracts. So if you've got a big supplier, they might have a director's guarantee in their contracts. Or same with the lease, same with the finance, like the bank when you're lending money commercially to a company or a trust. So often they want a director's guarantee, and what that says is if the business entity can't pay the bill, then we can call on the assets of the director. So again, some of those are open for negotiation. Suppliers and leases, you can generally argue. The banks are a bit hesitant to do stuff like that, obviously because it sends a bit of a signal that you're yeah, you might be ill-intentioned if the entity doesn't pay, but anyway, it's worth the question, right? So yeah, again, just keep that in mind. The next one here is insolvent trading, and this is kind of a big part of the risk I see for businesses at the moment, because I've got it kind of down the track in another slide, but there's a lot of control that we've lost as business owners of even when we open the doors and how we run our businesses and who we can let in the doors and all this sort of crap that sort of takes the control away from our ability to trade as we once could, where we call the shots on a lot of the things. So that includes, limiting who can pay us money as well. That's a reality of call it lockdowns, especially for bricks and mortar businesses who rely on people coming in. So insolvent trading throughout COVID time, the rules have relaxed around this for a period of time, but I think they've just been reinstated recently. Or at least ratcheted back up to some degree. But again, this is one of the biggest risks for businesses I see. Yes, the other two, or more so the director's guarantee, is a pretty constant one, but the insolvent trading presents a higher risk. If we are seen to be trading insolvent, that exposes our personal assets as directors as well. Just have a look. At what point is business considered to be trading insolvent? If the company forgot to pay a water bill or has an overdue paid debt to the ATO, is it insolvent trading? Basically, my understanding of it is insolvent trading is unable to pay bills as and when they're due. So if you forgot to pay a water bill, that wouldn't necessarily signal to me that you have the inability to pay, you just forgot it. And same with the overdue debt, it kind of relies on the circumstances around that. And again, my understanding is that it's more of an argument. If someone's having a crack to try to claim you're trading insolvent, they've kind of got to prove that, and you've got to kind of say, well, hang on, here's why I wasn't. But again, if that fails, you want, oh well, I think it's wise to have more safeguards in place. So I hope that one helped. And so, what do we do? How do we go further along that continuum? And lower our risk, and the idea of this is the person running the business or the director of the business is actually worth nothing, or in instances they can even be worth negative. So they become very unattractive to waste money pursuing with lawsuits and that sort of thing. And again, none of this is to be silly in business. Like I wouldn't just have a crack for the sake of it and end up losing money for people. But this is for genuine circumstances, right? And we've been faced with that over the last 18 months, that it's pretty, that there is, to a point, a huge degree outside of our control. Cool. Now, the other thing we can do from a structuring perspective is, especially when we've got let's say a husband and wife who are in the family group, we can assign someone to be the risk taker and have them take the risk taker roles in structures that we set up, and ownership of assets and businesses and things like that. And then we can have the asset holder role. So when we've got a couple, we allocate one of them as the risk taker. And they're the director of the trading entities, director of the trustee companies of trading trusts and things like that. I know I'm using a bit of jargon here, but please bear with me. Again, you can always clarify either in the questions or one-on-one with an accountant as well. And then this last point here is, ideally they hold no assets. So yeah, we don't want the risk taker to be an attractive target to sue if things get a bit ugly. And then on the other hand, the asset holder, they control the assets and the holding entities. So the asset trusts and bucket companies, they'll have control over those ideally, and 100% ownership of the family assets like the home, cars. Typical roles are the shareholders and the trustee of appointors of asset trusts is the sort of language we're using when we structure with clients. So again, that's like a a prudent step for almost like an easy fix. Now, we do see that when we onboard a client, sometimes the husband and the wife, in the instance, are directors of the trading entity, and maybe they own the family home 50-50. So I wouldn't freak out so much at that point, but what we do is we educate the client around it. Hey, that's not ideal. Ideally, we did that stuff from the start. We can go and change things. Changing it might cost money. Yeah, it might be a little bit in accounting fees and tweaks. But if we go and move a family home, there's actually stamp duty consequences. So again, some people want to do that, some people don't. But we've got to make a judgment call there. But the thing to keep in mind is, yes, and by the way, there's still more things we can do apart from sell the family home to one of the spouses. But what we do keep in mind, though, moving forward, is every asset or investment we make with that family group, we want to be very careful about who owns it, and very careful about who the directors are after that point. So, yeah, as long as you're aware of potential issues in your structure, then we can have a bit of a plan of attack. Now, working with asset protection lawyers as well in the past, they talk about this 4.5 year timer that starts. So if you go and, let's say you've got 50-50 ownership of a family home, and you go and sell that from one of the people to one of the spouses to the other, even if it's at market rate, we still start this 4.5 year timer where the courts can potentially unwind that transaction and say that, hey, we need to unwind that because that was an asset protection move, especially if things aren't going well when you make that transaction. That can look quite interesting for someone trying to have a nudge at your wealth. So what I'm saying there is this stuff's better done from the start. Second best is changing what you've got, but keep in mind you've got that 4.5 year timer that starts. Otherwise, everything you do moving forward needs to be played carefully. Now, and just wrapping up the asset protection conversation, uncertainty is pretty high right now. It's been high for a while. Some of us can't control when our business opens. We've got labour shortages. I don't know if everyone on the call here is experiencing this, getting a hand of good people. The amount of conversations I'm having even in the last 3 or 4 weeks is, it's just people are leaving for heaps more money, or they can't find people. There's a couple of things I think play into that, which is this whole thing called the big resignation. I think it started in the US, or definitely the name probably came from the US. But it's also our migration hasn't been active for quite a while. So we're losing skilled workers who left when COVID hits, and we haven't got them back. So I think both of those things are huge. Material prices increasing, especially for the trades. That's crazy. Stimulus is stopping as well with governments and federal and state. It's definitely slowing down. On the other hand, it's not all crap, but good. It's good practice to have good asset protection even in the good times. Some people have had their best year ever as well. So I said that at the start of the call. It kind of depends on industry to industry and business to business. Most property owners' personal balance sheets have exploded. So let's say you had 300 grand in equity on a $1 million house. You've probably doubled your equity position there in the last 18 months. If it's gone from 1.3 million in value to 1.6, and you had 300 grand equity at the start, you've now got 600 grand equity in your personal balance sheet. So again, asset protection is definitely a thing to consider. And then this golden line from, I think it was, I first saw it in Alien versus Predator. They weren't referencing asset protection, but anyway, it's better to have it and not need it than need it and not have it. That is a good encouragement for it. How Inspire can help with this stuff. So we can do an asset protection review and have conversations around determining who the best person is in your family to be the risk taker and the asset person. Have a look at your existing structures and things like directorship, shareholders, appointors, trustees, make sure they're all set up in an appropriate way, or give you an action plan to fix that stuff. And then strategies to improve asset protection, like how do you own investments, businesses. We can look at gift and loan back strategies, asset trusts, securing debt owed from trading entities. There's definitely some strategies we can put in place to minimize the risk for our clients. So again, if you're an existing client on the call, then feel free to reach out to your accountant for this stuff. Otherwise, if you're not working with us yet, then we can have a chat more about it on the strategy call with one of our accountants. So that is kind of the first part of our webinar, which is all about asset protection. I'll kind of pause for a moment, grab a drink, and just wait for any questions that might come through. Otherwise, we are going to shift gears into estate planning. So feel free to pop a question in the Q&A box. Alrighty, nothing coming through so far, but we can always jump back and we'll have a bit of Q&A time at the end of the webinar as well. All right, leaving your legacy. Now, just some sort of opening comments or info on this. About 60% of Australians die without a will. I've seen so many different stats on that, but call it about 60%. And the idea there is don't leave your affairs in a mess for your loved ones, or the decisions up to the government. And as business owners, we need to plan for the inevitable, and sometimes we don't get a heads up. Like we pass away, and sometimes this stuff isn't in place. Or keep in mind, if you lose capacity to make decisions, let's say you're in a coma for 30 years, you can't go and create a will when you're in a coma. So again, the interesting thing is we sometimes don't get that heads up. Also, creating an estate plan is more than just simply doing a will. So, a $10 will kit from the newsagent isn't necessarily going to do your estate justice if you've got companies, trusts, self-managed super fund. You've got asset protection strategies like the risk taker and the asset person in place. It's just not going to cover it. The good old news agency will. Better than nothing, but still a bit of a joke. When you've got, kind of just said that, when you've got advanced structures like companies, trust, Smsf, there's much more to consider when you're looking on to pass your wealth on to the next generation. So what I kind of go through next is around the different documents you require, depending on where assets are held. So, so if assets are held are in your personal name, that is what your will covers. So if you own a car or a house, you're an asset person and you own a house in your own name, your will dictate where that goes. If the house is in joint names, like joint tenants, if it is joint tenants, then the rule of survivorship would take preference there, and it would go to whoever owns that with you. Tenants in common is dealt with differently. That should fall under your will. Now, companies, if you own assets in companies like a bucket company that invests in shares, we got to have a look at who owns the shares in that. Now, at Inspire, if we structured it, it would in most cases be a trust. Otherwise, sometimes we see companies owned in individual names. We don't love that, but sometimes we see it, and so then we look at the will. But if it is a trust that owns the assets, then we need to have a look at the trust deed. Now, with a discretionary trust, no one owns the assets directly. So they're owned on behalf of beneficiaries of the trust. And we need to have a look at who controls the trust. So when I say see the trust deed, we need to have a look at who the appointor is. Sometimes that's called a principal in a deed, depending on which law it was written by and which decade. But principal or appointor are our controlling roles in a discretionary trust. And we need to have a look at the clauses in your trust deed to say who gets that control if the appointer or principal dies or lose capacity. So again, that's something we need to keep in mind when you've got assets in trust, and most of our clients do. So very quickly, especially when you're a risk taker in a business group or a family group, your will probably has the least amount of assets there. Leader, yes, there will be a recording of this. So we'll send that out probably sometime this afternoon. Superannuation. So with super, we have to have a look at the nominations that you've got in place. So we call them binding death benefit nominations, or BDBNs is the acronym that we use as accountants and with the lawyers. Now, if you've got one in place, great. It kind of tells us exactly where your super needs to go. If not, then we need to have a look at the rules in your superannuation fund. Now, that could be an SMSF, or it could be an industry fund as well. They'll have their own sort of rules of how that's dealt with if there's no nomination. And then the last one here is insurance payout. So with what I mean by that is usually life insurance. So when you pass away, that'll trigger. I think it can pay out for a terminal illness as well, in certain circumstances, of course. Now, with that, we have a look at who the policy owner is. So if that's you personally, then your estate will get the money and be dealt with under the will. Otherwise, if you're a self-managed super fund, or super fund is paying that policy as the policy owner, then you'll have to look at your nomination. So see, a lot of it, you kind of, wherever the asset is, we look at, cool, if it's insurance, then we look at the policy owner, which could be one or two or three things. And then we got to, it's kind of a bit of a rabbit hole there, but see how it's, what I'm trying to point out here is it's not just simply, let's just do a will and we've done our estate plan. As business owners, we've got a touch more to consider there, especially when we've got asset protection in place and sort of these advanced structures. I'm covering this stuff pretty quickly. Surprised there's not more questions, but as I said, we'll have some time at the end where we can go nuts with the Q&A. Cool. Now, shifting on as well, the next thing I want to sort of talk about is testamentary trust. So they're a form of trust that's written into a will. They provide significant tax and asset protection advantages for keeping your wealth within your family. Cool. I'll get to that in a sec, Carol. Testamentary trusts help. So one thing is tax can be, the tax advantages can be great if the income is distributed to minors or people under 18. They get taxed as adults on that income from a testamentary trust, versus if they get distributions from normal discretionary trusts, they get taxed as minors. So you can only give them about $400 or so before they start paying basically almost 50% in tax on that income. So, but not on testamentary trust stuff. In terms of asset protection, there's a few benefits for this. The first one is future partners relationship breakdown. So let's say, you had Bob and Sally. Bob passed away, gave all the, let's say in option one, Bob passes away, gives it all to Sally in the will. Sally then re-partners with someone and that relationship breaks down, and that new partner takes half the assets of Sally. Then we're in a situation that's undesirable there. So how do we protect that? Then how we do that is option two, set up a testamentary trust. Bob carks it. All his assets go into testamentary trust, and there's a brick wall between the trust and Sally, so that like there might be assets in Sally's name which are open for attack, but the assets in the testamentary trust should be quite protected from relationship breakdown. And that goes for kids as well. So when we're passing on wealth to our children, like my Rose and Ezra, I don't know now who their partners are going to be. And so if our wealth is transferred into testamentary trusts, it gives that layer of protection for relationship breakdown and kind of keeps it within our, how do you call it, our bloodline or our lineage. Also, you can protect your kids from themselves. So the kid's spending it. So again, if it's in a trust and it has rules around how much and when kids can access it, you have a trusted family member look after it on their behalf until they hit a certain age, things like that. Prudent. And also keeping it in the family. So you can specifically exclude spouses of kids and their children in your testamentary trust as well. Again, that can be just put up a brick wall around your family assets and that sort of thing. Again, always better to have this stuff and not need it than need it and not have it. So Carol asks, with superannuation nominations, can that be a testamentary trust, not a person? So I'll come back here. So if super nomination, so what we can do there is a nomination can say, I'm going to pay it to the estate, or it can say I'm going to pay Bob's super is going to be paid to Sally directly. So we can choose. Now, depending on the estate and potential conflict in the, if someone was to die, we may choose one thing over another. But you can get superannuation into a testamentary trust. So yeah, I hope that's kind of helped clear that one up, Carol. Paul, if I want to set the condition that instead of paying a lump sum of my wealth to the spouse at once, just put it in the bank and pay it 10% for 10 years, do I need a testamentary trust or simple will? That's the sort of thing I'd have to run by the lawyers. Now, I'll kind of explain how our estate planning process works shortly, but often with situations like what you've put forward to me there, Paul, we'll kind of paint that picture to the lawyers and then get their opinion on how we should approach it. So often I've seen things like age hurdles to access an inheritance, or pay a certain percent each year. Sometimes the idea is great, but the implementation from a legal perspective is actually quite difficult, or it actually raises other problems that we kind of don't see until the lawyers go, well, hang on, back in 2007, there was this case and this happened and it didn't work out like this. So we kind of don't do that anymore. It's actually quite surprising how often things like you've suggested are actually great in thought, but don't actually work in practice. So I'm not saying that that's what that one is, but that is something that I would defer to the lawyers to answer. Estate planning is not set and forget. So you don't just do it once and that's over. So you should also do it when you're when you get married. And I'm laughing because I remember I've got a follow-on estate planning lawyer, and she got married, and literally beside her wedding or her marriage certificate, when she signed that, she signed her new will. So she'd prepared it all, and it was an Instagram post, and she was actually there signing her new will because the marriage actually terminates the last will that was done. So that's that's interesting. But if you have been married since your last will is actually void. So keep that one in mind. Also, if you have a relationship breakdown, I don't think that just cancels your will, but I don't know that you'd necessarily want to follow your what your will did say when you were with that person. So, do you still want them to get 100% of your assets if that was how your will was written? Again, time to sort of have a look to see whether it's still appropriate. If you have a child, so the way that we get our wills written with a client, sometimes it will actually take into consideration the family having more kids as they get older. So in anticipation of children, it's not necessarily a reason that you need to do your wills again, but if your wills don't have provision for children, then they might need it in there. So keep that in mind. The hourglass here is if time passes. So best practice on that is review it every 12 months or so, and then have a really deep review, probably with an advisor every 3 years, just to make sure your estate planning is solid. If you go overseas, change your residency, or you're going on an extended trip, and there's risk of bad things happening, Always a good stuff to get this sorted before you go overseas. If you get sick, terminally ill, that's probably not the trigger that you want to wait till to do your wills and estate planning. But if you are getting sick and you haven't got this stuff sorted, then the time is now. Or this one here, which might actually sort of couple into what we were talking earlier about people's net worth actually being worth a lot more if they hold property. If your wealth has increased through asset increase or business value increase or inheritance, things like that, it's always a good time to check that your estate plan is still up to date. Another cool thing, and this is actually where we'll talk through the pricing and process around estate planning, but your SMSF can pay for your estate planning. Check with your accountant or auditor, your third-party auditor, before proceeding with that. If you're working with us, then we do it in a way where your self-managed super fund can pay for your estate planning process. So it doesn't cost you out of pocket outside of super. And in terms of our process, we've been doing this probably since 2014 or 2015 now, our estate planning process. And very early on, we started this, but it kind of involves three different people. We've got you, the client, our lawyers that we work with, and Inspire. And the good thing about the lawyers we work with is they've been virtual since I think they started, so 2014 or 15 onwards. They came out of one of the big four law firms, and we've been working with them for quite a while now, and they have jurisdiction in every state in Australia. So again, that works well with our client base being spread throughout the country. And we call it Advisor Facilitated Estate Planning, AFEP. What we do is we basically hold your hand through the process, do the data collection and pitch the scenario to the lawyers. And then I'll go to the next slide. So that's us and the client. We plan together, summarize it and send it to the lawyers, have a three-way meeting. So you, us, and the lawyers all on the same phone call or Zoom meeting to review your scenario, answer any questions similar to the one you brought up before, Paul. Any sort of, if you've got certain concerns over people who might contest your will as well, we bring up that stuff then just to have a big conversation. And depending on which package you choose and how complex your situation is, we might only need one meeting. Sometimes we need two, and I'll show you the difference in pricing in a sec on that stuff. All the documents are prepared. So that's wills, memo of directions, power of attorneys, any other extra stuff we need. Sometimes we need to adjust a trust deed or a company setup, things like that. And then we do a signing meeting. Obviously, it can be in person if you're local to us in Queensland. Otherwise, it can be done over Zoom, and you may need a justice of the peace or similar, or a solicitor to witness that one. So that's the process that we go through. A couple of things to remember. Your estate may be worth a lot more recently, given investment and property prices, and the other thing as well, I hear, not so much from clients, but just in everyday life, is, why do I need a will? I'm not worth much. But if you've got a life insurance policy of $500,000 or $1 million, then that can very easily form part of your estate or your super, which may pay to your estate. So do keep in mind that it's not just the cash in your bank account right now. It can be a lot more than that. Now, in terms of our pricing, it kind of depends on your needs there. But broadly, we kind of put it into two groups. We've got simple scenarios and complex scenarios. So it includes family tree and business structure review. We document your assets and liabilities. It includes our fees, the legal fees, printing of the wills and estate documents, secure storage, so indefinite storage, which is pretty cool. It includes the documents of the wills for each person, power of attorney, memo of directions, and the testamentary trust as well, written into the will. So yeah, I think we've done one out of maybe quite a few dozen who didn't have testamentary trust written into the will at the time. So it's very, very common that we want that stuff in there. So in terms of the pricing, obviously we're simple and complex. It's basically $3,500 or $4,500. And you can see there's a difference in all the same inclusions in the gist of it, but it's more time with the lawyer. And we really need the longer conversations if you do have way more questions to be answered, or you've got some funny stuff family-wise going on that you really want to make sure that you reduce your chances of the will being contested and things like that. Or it might just be because of your significance of your assets, whatever it is. Sometimes we need that extra time and advice from the lawyers. So they're the kind of price guides. At the end of the day, it's not a crazy amount to, as I said, for us to sort of hold your hand through the process and give you that outcome. And also keep in mind that your SMSF can pay. It is tax deductible to the SMSF. Otherwise, if you pay outside of super, because tax advice is a component of this process, we can claim 50% of the fee as a tax deduction if you pay outside of super. So that is still a pretty great outcome. What have we got here? The pricing doesn't include some extra stuff that may be needed, like a binding death benefit nomination or deed variations, company changes, anything like that may need. That might happen 1 or 2 times out of every 10. That's not super common, but it may be a potential. So just wrapping up the formal part of the webinar, a reminder for our option to have a strategy call with one of our accounting team. If you're not working with us and you want to have a chat further about what we've discussed today. And I do have some more of the webinar slides that we've got coming up about I'll just flick through them quite quickly. We've got the future webinars like the one with Paul Dunn about why your business needs a brand new story. Next one here is, are you doing the best you've ever done? What's next? And getting ready for when everything opens. And then we've got John Hollenberg and I with how to create a kick-ass website that works. So that's our webinars coming up. Thanks, Hitesh. I've got some time for... I'll read your comment in a sec, Steve, but with Q&A, I've got some time to answer some questions if you've got anything from today's webinar. So I hope that has helped. Steve, you said I'm from a different company today. Cool. I'll have a look at what you've registered under. Alrighty, but if you need to take off, thanks for listening and spending the hour or so with me, and hope to see you at a future webinar. Thanks, Wendy. Ben, cheers, mate. Awesome. Thanks, Karen. Yep, the team are ready. Steve. I've got a serial heckler. Thanks, Carol. Okay. All righty. Thanks for joining, Bradley, and I hope you might make it for the Paul Dunn one next week. Yeah, Michelle, the recording should be sent out pretty soon, so feel free to catch that first part. We spoke about asset protection for the first of it.